Hello everyone, welcome to today's presentation titled Navigating Stability, A Tale of Two Thermostats. We'll be exploring an interesting comparison between Federal Reserve and carbon pricing, two policy tools and two regularity mechanisms striving for stability in their own domains. Meet our regulatory heroes, the Federal Reserve and the carbon pricing. There are two distinct thermostats, each working diligently to maintain stability in their respective domains. Today, we'll unreveal their rules and how they contribute to the overall equilibrium. Much like how the Federal Reserve plays a pivotal role in regulating and influencing the economic landscape by adjusting interest rate and implementing monetary policies, carbon pricing acts as an analogous tool in environmental governance. Carbon pricing assigns a monetary value to carbon emission, either through carbon tax or cap and trade system, creating economic incentive for businesses and individuals to reduce their carbon footprint and transition toward a more sustainable and environmentally friendly approach. In this way, both the Federal Reserve and the carbon pricing mechanisms aim to shape behavior and promote stability, albeit in different domains. In the former, in the economic and finance, and the later in environmental sustainability. This table is collecting several aspects in order to compare Federal Reserve with carbon pricing. As you can see, there are several aspects, for example, primary authority, nature of policy, objective, key tools, and other. One of the main aspects is the influence on market. As you can see, for Federal Reserve, it directly impacts financial markets. However, for carbon pricing, it influences energy and industrial markets. There are other aspects that you can browse through in this table and see the differences by yourself. Now, let's focus on the economic thermostat, the Federal Reserve. Much like a central thermostat for the economy, the Federal Reserve fine-tunes interest rates to control the economic temperature. The primary goal is to achieve stable prices and fostering maximum sustainable employment. By placing a monetary cost on carbon emission, it aims to regulate the environmental temperature, mitigating climate change and promoting a sustainable future. The figure below depicts a model simulated global temperature anomalies for the last glacial maximum, which is 21,000 years ago, and mid-Holocene, which is 6,000 years ago, and projection for 2071, 2095 under worst case scenario, which is RCP 8.5, which is a representative concentration pathway, globally taken as the basis for the worst case climate change scenario. With a significant reduction in the emission of greenhouse gases, global annual average temperature rise could be limited to 2 degrees centigrade or less. However, without major reduction in this emission, the increase in annual global temperature relative to pre-industrial times could reach to 5 degrees centigrade or more by the end of this century. This slide illustrating how would a carbon tax work in Hawaii, and the central topic is the House Bill 2278, which establishes a refundable income tax credit to mitigate the effect of carbon emission tax on taxpayer. As you can see, there will be some advantages for this House Bill 2278. The first one is gradual cost adoption. So House Bill 2278 enables consumers to adjust the incremental cost increases, supported by a refundable tax credit that serves as a financial cushion. The second advantage is saving through energy efficiency. Consumers can maximize saving by embracing energy efficient practices such as conserving electricity, choosing fuel efficient vehicles, and enhancing home efficiency, allowing for more flexible use of refundable tax credits. And also, market shift for long-term benefits is one of the advantage of this House bill. The legislation's push for a transition away from fossil fuel encourages investment in renewable energy and clean transportation, leading to lower overall energy and transportation costs for consumers in the long run. Both the Federal Reserve and carbon pricing share a common objective: finding the optimum balance. Whether it's economic stability or environmental health, the key is to prevent extreme fluctuations and ensure sustainability. In this tale of two thermostats, the Federal Reserve and carbon pricing demonstrate the power of regulatory mechanisms in steering towards stability and sustainability. They play pivotal roles in shaping our economic and environmental future.